Do you believe you invest to grow your wealth? To secure your retirement? Think again. Wall Street solved its biggest problem, finding someone who will actually buy when things get tough. They found it. Not with an advertisement, not with a TV show. They simply changed the rules of the game, and most of us didn't even realize it. Your retirement money? What do you sacrifice today for security tomorrow? Now, it buys the risk that insiders no longer want to carry. This isn't about a specific IPO or an isolated bubble. This is about the fundamental architecture of the modern financial system. And it's using you. Before we delve into the hidden architecture that is rewriting the rules of your financial future, if you think it's worthwhile to understand what's really happening to your money, subscribe to the channel and activate the bell. We don't want you to miss the next revelations. For decades, investing meant choice. It meant passion, dedication, research, analyzing balance sheets, understanding markets, betting on conviction. You chose what to buy. It was an act of informed faith. But something fundamental changed. The very definition of investing was subverted. The act of selecting, of discerning value, was progressively automated. Today, for the vast majority of new money entering the markets, there is no longer choice. There is attribution. The system now chooses for you. And what it chooses is a standardized index that represents a vast chunk of the market. Markets used to discover prices through a myriad of individual decisions based on fundamentals. Now, flows dictate prices. And most of these flows are automatic, blind, uninterrupted, and the primary engine of this automatic attribution, ETFs. The Trojan horse of this transformation was ETFs, exchange-traded funds. Created with the promise of democratizing access, they became the backbone of passive wealth accumulation. The idea seemed harmless, diversify cheaply. But the scale these giants reached changed the market in a way that few understand. The demand for an ETF is not a vote of confidence in a specific company. It's a demand for the index. And when you buy an ETF, you're not buying a company. You're buying a package of stocks. And the demand for that package forces the ETF to buy the underlying stocks automatically, without question, without looking at the fundamentals. Now imagine this on a trillion-dollar scale. When trillions of dollars of passive money flow into ETFs, it creates a continuous and mandatory buying flow of stocks. Stocks that sometimes don't even deserve this demand. And the trick to guaranteeing this demand? The mechanics of inclusion in indexes. When a company meets the criteria to be included in a major index, ETFs that track that index are obligated to buy its shares. It doesn't matter if the company is losing money or if its business model is obsolete. The buyer no longer needs conviction. The system itself has become the buyer. This creates a brutal distortion. The price of a share ceases to be a reflection of its intrinsic value, of its ability to generate profit, and becomes a reflection of the index's engineering and the appetite for ETFs. This is not investing. It's absorption. Look at the AI wave, a technological frenzy that promises to rewrite our future. It's the next big revolution, right? Is the market simply rewarding innovation? Think again. The AI bubble isn't just a bubble of speculation about technology. It's a bubble built and sustained by the same passive flow machines we discussed. When passive money, forced by index mandates, needs to invest in AI, it doesn't look at profit. It looks at index inclusion. It looks at liquidity. And the artificial demand this creates is immense. The bubble no longer needs buyers with conviction. It only needs automatic flows to sustain it. Remember the dot-com bubble? Back then, when companies didn't deliver, the money stopped flowing. Fundamentals eventually won. There was pain, but the system cleaned itself up. Today, the system is different. Index inclusion guarantees buying. ETFs need to buy. The bubble can't burst the same way. It's mechanically sustained. This creates a trap, a bubble that becomes politically impossible to let collapse. Regulators and the system itself have an incentive to keep it inflated, because its collapse now would mean a systemic collapse on an unprecedented scale, driven by the retirement infrastructure itself. The market may have stopped caring about profitability. It cares about flows. And those flows largely come from your retirement savings. And where do insiders and private equity funds find this guaranteed demand to sell their own holdings when the time is right? They find it in you. The modern market structure, driven by passive investing, has created a perfect liquidity engine for private equity. They buy private companies, often using debt, work them for a few years, and then their main goal is to sell. The private equity fund doesn't create value. It engineers liquidity. IPOs today are less about raising capital for company growth and more about creating an exit for the original investors. They know that, thanks to ETFs and index funds, there will be a structurally obligated buyer to buy their shares as soon as they are included in the indexes. This artificial demand inflates the price at the time of the offering. PE funds realize astronomical profits, often even before the company demonstrates a sustainable profit trajectory to the public. Your retirement fund, your IRA, your 401k, they are no longer just growing with the market. They have become the subsidy for insiders to sell their assets at a profit. You're not buying the future. You're buying their exit. It's a closed cycle. Passive money creates constant demand. This demand allows private equity firms to sell their stakes at a profit in IPOs. These IPOs, once listed and included in indices, are bought by passive funds. And you're at the end of that flow. Liquidity used to come from the markets. Now, it comes from your retirement plans. Your retirement plan. Your pension funds. What seemed to be a safe haven for your future has become, unbeknownst to you, one of the essential pillars supporting this entire architecture. These funds represent trillions of dollars in capital. Long-term capital, seeking consistent returns. And what do the managers of these funds see? The massive and reliable flow of ETFs. They see the promising, even if engineered, returns from IPOs orchestrated for liquidity. They can't afford to stay out. Staying out would mean failing to meet return targets, generating distrust, and potentially leading to restructurings for the managers themselves. Therefore, they participate. They buy the indices. They buy the exit IPOs. Your retirement money isn't just invested. It's the driving force that keeps the machine running. The financialization of retirement isn't just a term. It means your future security has been transformed into a component of a financial machine. Your savings are no longer just for you. It is vital to the stability and liquidity of the system as a whole. The disturbing truth is that passive demand, fueled by its own retirement funds, has created an artificially inflated market. And now, the collapse of that market would not just be a financial crisis. It would be a social catastrophe, eroding the hope of millions. And that's where the ultimate incentive comes in, the ultimate protection for those involved in this system. If the market sustained by retirement savings, driven by index flows and PE outflows, threatens to collapse, what happens? The pressure to intervene becomes overwhelming. Because collapse means trillions in retirement savings evaporate, destabilizing society and government. Bubbles in this era become politically impossible to allow to burst. Governments and regulators then have an intrinsic incentive to ensure that these markets do not collapse. They create the perception, and often the reality, of an implicit bailout. If large banks and large systemically important fund managers are in danger, the state intervenes. This generates a dangerous moral hazard. When participants know there is a safety net, a promise of bailout, they feel more comfortable taking greater risks. They know that if something goes very wrong, the ultimate sacrifice will be passed on to the public through monetary inflation, loans, or other forms of bailout. Your retirement money isn't just fuel. It becomes the justification for a bailout. The system is designed to protect these flows, and the best way to do that is to ensure that buyers, your funds, never exit at a catastrophic loss. This creates a vicious cycle. More risk taken, more need to safeguard the system, more intervention, more risk taken. Genuine price discovery is replaced by a game of liquidity engineering and risk shifting, where insiders who know the game know when and how to exit. The secret isn't that they steal your money. The secret is that they've turned your future into their exit strategy. What began as a promise of democratization and simplicity for the average investor has culminated in the machine we are describing. A machine that has silently redefined the purpose of your retirement money. Make no mistake, this is not a temporary problem. The dynamics we have explored, the centralization of purchasing power in ETFs, the liquidity engineering in IPOs, the mechanical support of bubbles, and the incentive to bail out the system are the new foundations of the modern financial market. The system no longer needs buyers with conviction. It only needs flows. And these flows come from all of us, investing passively, in the name of future security. You have been programmed to be the ultimate liquidity. Passive investing, which many embraced as the smart and safe answer, may have become the most effective tool for transferring risk from informed and agile insiders to blindly investing workers, following the flows. You will never again be able to look at an index fund, an ETF, or the very idea of passive investing in the same way. The illusion of choice has been replaced by automatic absorption. The promise of personal growth has been converted into a guarantee of liquidity for others. The question now is not whether the system is broken, but how it was built to function exactly this way. And what does this mean for the future of wealth accumulation? What did you think of this revelation? Leave your comment below. We want to know your opinion and the experiences you've already had. Like this video if it made you think differently. And if you want to understand the next layers of this complex financial architecture and how it can